the 1972 market is partying like it's 1999. What does that mean? It means we're living in a world that's somewhat of a combination of the late 90s with the technology stocks and sectors doing extremely well, the valuations very, very rich, I would argue in bubble territory, but also the build out that we're seeing in the infrastructure of the technology side, and all these capex light companies are now becoming capex heavy companies, and the returns in our view are just not going to be there in the future, just like they weren't there for a lot of the companies that struggled in the aftermath of the dot-com boom. And then you couple that with a world where we're seeing more inflationary pressures, and a world where we're seeing ultimately the sovereign debt pressures, combined with resurgent labor, with labor tightness occurring in the Western economies, especially the US, you're going to see a resurgence of inflation, and that's going to push rates higher.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Wasif Latif. So Wasif is the president and CIO of Sarmaya Partners, with 25 years of experience managing equity, global multi-asset and multi-manager portfolios in mutual funds, ETFs, wealth management, and institutional portfolios. So Wasif, thanks so much for coming back on the podcast.
Thanks, Anthony. It's great to be here again.
Yeah, no problem. Really looking forward to the conversation. And we're just talking before, and as you're saying, a lot of what you said sort of 6 months ago has come to play and has sort of played out as you suggested. So yeah, if you can just lay the groundworks of what you're currently seeing, I guess, in the economy and in markets and what you're watching.
Yeah, so well, again, thanks for having me on. And, for the past several months, over a year, we've been really focused on what we call the tangible parts of the market. So tangible assets, like commodity-oriented equities. And that thesis has been playing out in markets, and we've been investing in that type of a strategy for a very long time, going back several years. And our view is that the world changed in the pandemic. So history will look at the world and look at everything pre-pandemic versus post-pandemic. And that includes markets, interest rates, inflation, and ultimately the market leadership of how that eventually will change and shift around. So the overall market right now is that the narrative is all about, in the US, AI-driven names and the technology boom that still continues on. But when you look at the stuff underneath the covers, it's actually a tale of two different markets. So the headlines are saying it's all about AI and technology and some of those names. And with the exception of a couple of names, those that really haven't performed as well as what we are looking at, which is the other part of the market that doesn't get as much notoriety, which is the tangible parts of the market, like precious metals and some broader commodity type of equities. And we think that that's where really the opportunity is. A lot of those places for the longest time had been underowned, underloved, and ignored. And fundamentally speaking, there was a lot of attractiveness in those areas. And we think that a lot of the catalysts since the last few years have coalesced to make that to be the really great opportunity. So everybody's talking about gold, silver, and platinum. They are up significantly. They're outperforming the S&P year to date. And the mining companies that are representing in that space, that are actually doing the work, the mining and the extraction and the selling of those commodities, are up even more. As you can imagine, they have a higher beta to that, and that's doing even better than the overall portfolio of the equity portfolio in the equity space when it comes to the overall markets. So we think that's really where the opportunity is, and what this market is at the headline really focused on is rate cuts. Today we're recording on November 12th, and middle of the day there was this concern that emanated that the Fed might not be cutting in December as much as it was thought earlier. So that got discounted, and all of a sudden you saw a leg down in the market. So this market is definitely trading on the hopes and the aspirations that the Fed is going to cut. And while that could happen, and that actually might likely happen, that they might still cut, I would still put in odds of a cut more than a not cut in December. But even then, that means that these kind of commodity type of oriented securities will do even better because of the world we're in, and the market's been moving in that direction and trading along those lines. The other thing is that on a short-term basis, you're getting this overall sentiment that inflation has receded and interest rates are on the downward move and a downward trend. We don't agree with that. We think that inflation is still with us and it's likely going to edge higher. And any kind of reduction or receding that we see in interest rates is likely going to be more of a short-term cyclical move based on economic growth or economic weakness. And in response to that, when we do see the Fed coming back to the market, not only cutting rates, but even potentially going back to doing QE, we think that at that point, you're going to see the markets really react negatively, not in the positive way, because of what's going on vis-a-vis the overall deficit, the overall inflation. And in that scenario, I think that's when the commodity space, like precious metals, is going to do even better. The last piece I'll talk about is oil and energy-related securities, oil and gas. They haven't really participated as much, especially the oil side. Gas has done a little bit better because of its tie-up with the AI energy needs and that trade. But we think that oil is going to be the story for next year, and it's going to do something similar to what we have seen in precious metals this year. And so we think that that's going to be the important part of what drives it. So to me, the punchline is the headline of the paper that I wrote several months ago, and the title of that paper was basically "The 1972 Market is Partying Like It's 1999." What does that mean? It means we're living in a world that's somewhat of a combination of the late 90s with the technology stocks and sectors doing extremely well, the valuations very, very rich, I would argue in bubble territory, but also the build out that we're seeing in the infrastructure of the technology side, and all these capex light companies are now becoming capex heavy companies, and the returns in our view are just not going to be there in the future, just like they weren't there for a lot of the companies that struggled in the aftermath of the dot-com boom. And then you couple that with a world where we're seeing more inflationary pressures, and a world where we're seeing ultimately the sovereign debt pressures, combined with resurgent labor tightness occurring in the Western economies, especially the US, you're going to see a resurgence of inflation, and that's going to push rates higher. And in 1972, the Nifty 50 stocks, similar to the Mag 7, were seen as infallible, were seen as bulletproof, that nothing could ever happen to them, monopoly-like companies. And ultimately, they declined significantly and struggled as companies. Why? Because of the sheer weight of their valuations in the face of rising rates and the discounting that needs to happen according to that. And then ultimately, when you combine that with the excessive spending that's going on in the AI boom, we think that that's going to mean trouble for that space. And in the meantime, when you get higher inflationary era and you get the kind of fiscal dominance and fiscal pressures we're seeing, we think that places like the tangible sectors that we are invested in, like precious metals and energy and copper, we think that that's where the real opportunity is.
Yeah, great. So much to unpack there. Thank you so much for sort of laying out the groundwork. So what do you see as a driver of that, added inflation that you mentioned, you sort of says into the Southern East? Yeah, I'd be interested to hear how you sort of look at that and why you think it's going to continue, whereas
Yeah. So I think on a short-term cyclical basis, you could say inflation might recede, but on a year-over-year basis, we've already seen that move down a little bit. And I think you're going to see some year-on-year comps that push it higher. But what's going to drive it? I think it's going to be the higher costs from the tariffs facing the consumer, but also some of the wage pressures that might still be there from the tightness of the labor market. But more importantly, it's going to be the continued stimulus that we're seeing coming through from the fiscal dominance and the fiscal spending that's happening. I know you've talked to Michael, how I follow his work. The liquidity environment is very, very much, I think, a dominant factor, has been a dominant factor in these markets pretty much since the great financial crisis in 2009, with all sorts of stimulus coming through in different ways, whether it's QE early on, which impacted the financial markets, not the real economy, and then the fiscal stimulus coming in, the double barrel bazooka that the Fed shot and the government issued, all that fiscal stimulus, all that combined to create inflation. The thing about inflation is once it's out and in the system and in the economy, it doesn't go back easily. It permeates and it moves around the economy in different places. And you've sort of seen that. First, it was goods in the aftermath of the pandemic, and then it was other parts of the economy in terms of the imported prices. And now we're likely to see some of that pressure in the services side with wages continuing to be stubbornly high. Now, housing, that's a big component that might, on a near-term basis, pull it back, and that might dampen it a little bit. But I think that in response to any slowdown in the economy and a fear of deflation from the Fed, I think they're going to come out and provide greater interest rate cuts and potentially QE, which then, as I said earlier, I think will trigger actually a greater inflationary impulse that we think that we're over with. And the last piece is on the fiscal stimulus side, it looks like that this administration, what they're trying to do is a run it hot economy like the 1950s. You might know in the 1950s, we came after the war, we had high levels of debt, and in order to grow our way out of that debt, but also grow the economy, there was a lot of government stimulus. There was a lot of controlling of prices in terms of the yield curve, which provided this inflationary impulse. But at the same time, the economy was growing. So I think that's what the government is trying to do with a 1950 style run it hot economy. The risk is you end up with a 1970s stagflationary bust, because alongside that stimulus, we have tariffs, which can act as a tax and which can act at the same time as a tax, but also create higher prices on certain goods. So the complexity of that might actually turn this environment into a stagflationary environment. In either case, when you look at what does well, whether you get stagflation or high run it hot inflation, you get commodities doing well, and especially commodity equities where we play. And we think that's where the real opportunity is. So whether we get inflation or stagflation, we're getting inflation. And as a result of that, we think that this type of a portfolio will do well. And then at the same time, the longer duration type of sectors like technology might struggle if rates are higher and the cost of capital is higher and the cost of labor is higher. And now they've gone into a lot of CapEx spending where the money might not show up.
Yeah, great. Really interesting. And I guess my question is this just sort of something that you see similar globally, or is this more sort of a US phenomenon? How are you sort of tracking that?
Yeah, that's a really good question. So I would say it's going to be, this more or less is centered around the US, but I think it expands through to the developed countries, the Western countries. So we know Western Europe is struggling with high levels of sovereign debt. France is continuing to struggle, and there could be some news that comes out of it soon, where we could see some issues around their ability to service their debt or pay down their debt. So it looks like this is more of a developed world challenge led by the US, whereas on the emerging country side, yes, they are tied to the US economy to some degree, but more and more so they're tied to the Chinese economy. And when you take a step back and you look at the global picture of what country or region is creating stimulus in a market or an environment that has the potential of absorbing that stimulus and moving higher. We know that we're providing stimulus. We know that the Europeans are not doing a lot of fiscal stimulus for defense purposes, but we know that China is now doing stimulus as well through its PBOC activities. And so China could be the driver of growth for the rest of the world, especially Asia. And so the opportunity might be in Asia, and their demand might continue to high. In fact, that is a big component in our thesis of why we think energy demand will continue to rise. There's a chart I usually show in my presentations, which is the use of energy across different kinds of energy. So oil, gas, nuclear, coal, solar, wind, all of that stuff, and show its components, but then show the overall growth of it. And what is interesting is that since 1960, that line has done nothing but go up. And we think of the consumption driven by the OECD, the developed countries, but when you look at it, the real growth and the need and consumption for energy, especially oil and by extension natural gas, is actually coming from Asia, from those countries. So we think that that's going to be a brighter spot. It's not going to happen immediately. It's not going to happen overnight. Similar to what happened in the late 90s and the early 2000s, you had a run up in the US driven equity market from technology, which then also impacted the other markets. I was an investor, I was a portfolio manager managing Asian equity portfolios back at that time. And I had a lot of tech stocks in my portfolio, which went up similarly to US tech stocks. But then in the aftermath, they also went down. So what I'm saying is that whatever kind of economic short-term cyclical slowdown that the world might see, or any kind of pullback in the equity market, Asian markets and emerging markets by extension will feel it. But in the aftermath of that, when you do have the central banks of the world coming back in and providing greater and greater liquidity, you're going to see those markets do even better, similar to what we saw in the 2000s. And lastly, emerging markets tend to do better when there's global economic growth happening, because they can grow and benefit from that. They do better when you have a accommodative Fed, and by extension, they do better when you have a weak to stable dollar, and that's when they do better as well. So those three conditions, they're a bit mixed right now, but I think when you get into this post-cyclical slowdown, which might occur sometime potentially next year, post that, when the Fed goes and begins to fire more bazookas, which I think it will, that's when you're going to see all this stuff do a lot better. And then one last thing is, an indication of that really came in, and I'm sure you other folks have talked about it. I know you talked to Jim Bianco, he's talked about it a lot, which is the first Fed cut last year actually sent bond yields higher. But it triggered, a rally in risk assets, and even in Asian markets and commodities, especially it lit a fire under gold and other precious metals. That was the market telling us that inflation's still in the system. The market's not convinced it's out of the system. And that's, I think, going to come back in spades whenever the Fed does go full throttle on stimulus later on. And it might coincide with sustained or greater fiscal stimulus, because the fiscal stimulus I think is going to be there, and as well it's going to be something that's going to contribute to the inflationary impulse because of the environment we're in.
Okay, yeah, we're really interested to hear that. And I know you mentioned oil there, and you mentioned a few times,
Yeah.
and you think it's sort of going to be a big player into 2026. But if I look at sort of the supply demand dynamics, it does look like there's going to be quite a lot of supply versus, I guess, the estimated demands of what people are looking, especially in the first half of next year. So do you just think the demand is going to be higher? Do you think there's going to be maybe less supply coming online? How are you looking at that?
Supply is definitely there, and it's a decent amount of supply that's coming in, and the market's expressing it. Here's the thing: the market's already pricing that. If we're talking about it, it's in the headlines. It's showing up in the activity. It looks like to me that a lot of it is in the price. Now, despite having the narrative and the story that it's in the price, that there's a lot of supply coming online, oil's not going to 40. It hasn't gone to 40 yet. It might go if we get into a real recession and there's a big significant panic sell-off, and if that occurs, to me, that's a great buying opportunity. Why? Because the cost of production for the U.S. producers is no longer the low number that it used to be, and it's a lot higher in this cycle. So to me, 60, 58, 60, 62 is the number where the cost, the production actually stops, rapidly increasing, at least from the U.S. standpoint. Yes, there's capacity outside the U.S., and with more and more discoveries, some of that might be coming on. But at the same time, the world is still continuing to grow its oil demand, and that's not going away. And as you know, Anthony, oil is priced at the margin in terms of the incremental change of the marginal barrel that's produced and supplied and sought after. So we think that that's just going to be there. The story that's out there in the market is all about too much supply, too much supply. What gets ignored is that the demand side is still there and it's still strong, and it is continuing to rise. And countries like India, the per capita usage of oil in terms of the barrel per usage per capita is still extremely low. And all they need to do is incrementally, just at the margin, start consuming a little bit more. And they have the potential. They've indicated that they want to grow, they want to build their infrastructure. And if that happens, and when that happens, you're going to see continued demand rise. Lastly, on the supply side, there's a famous chart. We've rebuilt it from the folks at Exxon that started it, which shows that the continued investment that's needed in oil and in energy to be able to produce the oil of the future is not happening. So the new wells and the new holes in the ground and the discoveries, they're not being cultivated as fast and as much as will be needed to be able to meet that demand in the future. And when you look at the news that I think just came out today or yesterday, I think it was yesterday, the IEA finally capitulated and acknowledged what the rest of the world has known and seen for quite some time, is that their view of the demand for oil tapering off and curtailing, in the near future was not realistic. And that's going to continue for many, many decades. So I recognize that there's supply, but I don't think the market recognizes that the demand is going to be there, and that supply is of today. It is not the supply of tomorrow, because we don't have the reinvestment that needs to take place to be able to build that.
Yeah, it's a really great point. And as you said, that article was quite interesting from the sort of outlook update from the IEA. 2019, they shifted saying we need to stop drilling, and now they're saying we need to continue to drill. And
Right.
Yeah, it seems to be there is a need and an expectation that oil at similar levels will be required until at least, I guess, the next 20 years.
Yeah, I think it just goes back to their thought that we're not going to need as much carbon-based oil or gas, because we have all these alternatives, and the energy transition is going to take care of everything. Well, there's a couple of realistic sort of physics related items that you can't ignore. Number one, the benefits that solar and wind derived from subsidies cannot be ignored. And those subsidies were there in the era of free money and cheap energy. And that era is gone. So the world is different and the world has changed. The pandemic really moved the world into a new era. History will show that. And I don't think many people appreciate to the degree that it changed and the amount of things that change, and the realization of energy and the realization of the need for commodities, broadly speaking, has gradually been coming back. And now it's in the headlines with the need to have strategically important metals, strategically important minerals, and rare earths that are needed for defense purposes. So we crossed the Rubicon, and that's why our strategy, we intentionally named it the return to tangibles, because the world had forgotten that in the post GFC world, all the way to pretty much the pandemic, with pretty much cheap money and cheap energy, the idea that, the advent of the digital world, the granted very valid confluence of technology between hardware and software, and the ability for consumerism and social media to really dominate our lives. I think the world had forgotten that all of that digital world and all of that digital growth is built on the dirty, grimy, ugly commodities. And the world had forgotten that. But I think the reality is that it was grounded in this belief that we're focused on this big digital stuff that's great. Who needs these ugly, dirty commodities? But I think it was based on free money, really, really cheap energy. And I think that era is over. And now that's why the world is returning back to the tangibles. And that's why we love that phrase. I repeat it every chance I get, because it's like a coming back to what the world realizes is actually important. So some of our sub themes are reflective of that. That energy is life. Everything that we do, every single human activity is energy transformed, and you cannot have human activity without the foundational usage of those energies. So I think we're coming back to that. And markets go through cycles, human history goes through cycles, and there's a lot of things that contribute to that. And I think in the post GFC world, the deflationary pressures that were there forced rates to be zero. And when you get free money, when money doesn't cost anything, then a lot of weird and probably unhealthy capital decisions and capital allocations get made. And they only come to light once you get the real cost of money returning to where it naturally is over the long arc of history. So that's really, really important from our vantage point.
Yeah, okay. And I guess another asset, or sort of assets that you've held recently, and I think it's led to you sort of going extremely well this year, has been precious metals, the miners, I guess copper miners as well. And they have had a massive run, I guess you could say, the last six to 12 months. So why do you think that's going to continue? I know there's lots of trends behind it, but is there a point where you're like, okay, this has actually had a massive run, I need to start taking profits, or how do you look at that?
Yeah, so we our strategy is actively managed. We focus on the broader tangible world, and then within that we have subcomponents and sub themes. So energy is life. So earlier on in the strategy, a few years ago, about 3-4 years ago, it was we had a heavy emphasis on energy and oil and gas, and that really helped the strategy and our portfolio. And in early 24, mid 24, and then certainly in the second half of 2024, while we had gold and gold mining stocks in the portfolio, we significantly increased that in our portfolio. And here's a couple of reasons. So we've all talked about it. The world now knows, as common knowledge, about how the Russian invasion of Ukraine changed the perception of the dollar for the different central banks around the world, and they have been a net buyer of gold. There's a clear indication. You can see the charts of how that picked up. We don't think that's changing. I think that is going to continue to happen. The amount of gold that China and Russia have bought, still on a relative basis, is still not as much as they would like if they want to get anywhere near at par to what the U.S. has in terms of a size of the economy or size of the population standpoint, or just being able to build that cushion and reserves. They still have dollars in their portfolio that they're probably trying to diversify away from. We're not talking about de-dollarization. The dollar isn't going anywhere. It is the reserve currency in the world, and it is probably one of the best networked currency and assets in the world. It's not going anywhere. However, over the last 60 years, you've had $3 bear markets where the dollar has declined for a variety of reasons, whether it's relative interest rate differentials with what the rest of the world was doing and the US was doing, or the growth in the other parts of the world, or simply a change in the monetary system like we saw in the 70s. But in either case, the dollar receded and declined, and we think that we might have entered that era as well, where you will see a decline in the dollar. So for precious metals, the drivers are inflation. It is how the fiscal health of the overall reserve status country is doing, or but broadly the sovereign nations of the world. It also depends on, as we know, geopolitical risks, and we think that all of those risks are still there. They're going back and forth. So gold has had a strong run up, silver even more, but silver is just trying to catch up, and it hasn't, when you look at the ratio, it's nowhere near where it potentially could be, given how strong the run up in gold is. And similar to platinum, it is still trying to play catch up to gold. So gold is sort of the center and the leader in this space, and the others are following. Strong returns this year, pretty good returns last year as well, but we think there's more to come. Why? Because the fundamentals of the stuff that's going to drive gold, in our view, is still intact. Inflation, yes, it's receded, but we think it's still lurking in the system, and you're going to get another surprise. We've had one big inflationary flare in the early 2020s, in 2021, 2022, and I think that's going to come back. I usually say an inflation spike is like a cockroach. When you see one, you're going to see a couple of others. And when I show this chart where it's really tracking similarly to the inflationary episodes of the 70s. So inflation, I think, is still in the system. It's not out of it. And you're going to get another pretty impactful spike in inflation where gold should respond. Number two is the geopolitical side of things. And as I mentioned, the central banks have been buying gold as a diversifier away from dollar assets, not only a diversifier of dollar assets, but also hedging their geopolitical dependency on the US banking system and the US monetary system. And that, in our view, will continue. So now you have a systematic buyer that is indifferent to inflation around the world, that is probably indifferent to price, because this is a strategic reserve that they're generating. So they're in the market on a regular basis, coming in opportunistically as needed, but they're there. So there's this persistent buying pressure that's noticed in the market by participants. And so with the sell-off of 4,000, there's a lot of calls that people are making that maybe 4,000 is the new 2,000. That could happen. In 2000, you saw that spike to gold, and in 2020, you saw it jump up to 2,000, and it kind of consolidated there for quite some time. So with this pullback in gold, will we see a prolonged consolidation or a short consolidation like we saw in the summer of this year, where it was roughly 3 to 4 months? Nobody knows for sure, but I would argue that the consolidation is probably shorter lived because of the awareness that now gold's performance has generated. And now you have people who are buying it on momentum. Now you have a lot of investors who hadn't participated in gold and now beginning to participate across the world. And it is a global asset, and you're going to see that pricing pressure coming in. The last piece is the fiscal side of things, and the U.S. fiscal situation is unsustainable. We know that, with all of the untouchable areas that we have to spend money on, that really doesn't leave a whole lot of room to cut the budget deficit. And what we've learned, if anything, is that the U.S. I'm American. We don't do austerity, and so when governments, historically, when you look at history, when governments are faced with this type of a situation, there's a couple of choices. You can issue austerity and really tighten the belt, which is a surefire way of getting voted out of office. You could default, which I don't think is going to happen. I don't think anybody thinks is going to happen. Or you can inflate your way out of the problem by letting inflation run a little bit hotter than you would otherwise, and therefore, over time, reducing the overall real value of the level of debt. And when you do that, then real assets like precious metals, like gold in particular, they move up in the defense of the purchasing power. So that goes to the whole debasement trade that everybody's been talking about. And we think that the debasement trade has been going on for quite some time. Now it's just picking up more and more steam. but this rally in gold to us is still in the early innings. And I think that it has more legs to it. We don't know exactly where it ends, but I think it'll be somewhere like a combination of what we saw in the 1970s and the 2000s, which were the last two big bull markets in not only commodities, but led by gold. And we think that's going to happen. And it might be, the combination of what I said earlier in terms of the relationships of what's going on with the market and the economy and interest rates and inflation, that we might get that 70s and 2000s combo.
Yeah, great. Thank you so much. So, Wasif, thanks so much for your time today. I appreciate you running us through sort of your whole thoughts about the economy, inflation, your portfolio, why you're seeing this, I guess, return to tangibles. But my last question is, what is one message you want people to take away from our conversation?
Well, thanks, Anthony. I really appreciate your time. I'm a student of history. I'm a economic history, market history nerd, and I think you can learn a lot from that. So my message would be, learn from history. Markets are cyclical. This stuff has happened before. There are shorter term cycles, and then there are secular cycles. And figure out which one you prefer and you like and want to play in. But I learned that and understand it, and invest your portfolio accordingly. We are secular investors, and so we see this as a secular cycle that really started in 2021 and is going to run its course probably for the next several years. And as a result of that, what was the leadership prior to that, or even up until recently, will, in our view, not be the leadership in the future. And if you don't learn about the cyclicality and the changes, and you think that what is growing today at very, very high multiples is going to go on forever, there might be some disappointment there.
Yeah, great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
I would say the best place is our website, sarmayapartners.com. They can also find me on LinkedIn and Substack under my name, Wasif Latif. And I'm also on Twitter X under my same name, so they can find me there as well.
Great. I'll put a description below, but thanks again for your time.
Thanks a lot, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.